I see profitable business owners make decisions every year that feel smart, and then it shows up as a problem on their tax return 1 or 2 years later. By the time they see it, the money's already gone. They're not reckless owners, they're smart business people. But the mistake doesn't show up then on that tax return. It shows up years later or the next year. Let me explain what I mean. This video isn't for people trying to game the system or come up with some sort of tax cheat. This is for business owners who are profitable and trying to be responsible. If you've ever been told you should spend $1 or spend money before year end so you don't have to pay tax, this video is for you. For those of you who are new, my name is Chris. I'm a CPA of 33 years, financial advisor. I work with business owners and high net worth individuals to develop strategy and assure compliance and a defensible tax return. So let's get right into it. Most of these decisions that I'm talking about are made with the wrong question. The question people usually ask is, how much will this save me? When really, the question they should ask is, what does this cost me after tax? Because here's the rule that most people miss. Taxes reduce upside. They don't justify bad decisions. If you spend $1, you save 30 cents in tax. You didn't save any money. You still spent money. You still are out 70 cents, right? Now, you can use that for capital budgeting purposes. You can use that for all sorts of planning purposes. What does something really cost me after the tax effect? That's fine. There's nothing wrong with that. But you will never spend your way out of a tax situation. The trap that I see people get into are financing purchases, capital expenditures. What happens is you pay nothing or little down and you get a big deduction. That works great in year 1, but in years 2, 3, 4, when you have to make the income to pay that debt back and you already took the deduction, that's when it hurts. You add that to 4 or 5 pieces of equipment and you wonder why you owe a tax at the end of the year and you don't have any money. That's one of the traps. And this is where I see people get in trouble, especially with equipment and finance purchases. I see it every December. Business owner, and this was an actual case. I had a client tell me that he was buying a piece of equipment for his business. And I had looked at his return. We had been working together for a month or two. We had already found savings. And I said, well, why are you buying that equipment? And he said, well, I need to spend this money before the end of the year. And I said, okay, do you need the equipment? And the answer was not really. The equipment didn't better his production. It didn't reduce employment obligations. It didn't reduce staff. It didn't really even prolong the life of that equipment. I asked him, I said, are you spending money in repairs and maintenance and things of that nature that, excessive repairs and maintenance? No, that wasn't the case. He just wanted to buy a piece of depreciable property to save 30 cents on the dollar. So what he ends up with is selling for scrap or very little the old piece, installing the new piece, having something that breaks down just as much as the old piece. It was manufacturing type equipment. And it was going to become worth less and less every day. Rather than paying the 30 cents in tax or paying the tax, keeping the 70 cents and watching it grow and become worth more and more every day. That's how businesses get themselves in financial situations, by trying to make their decision primarily and solely on the federal tax code. You can't do it, and it's not wise. It feels good, but it is not wise. The next one is subtle, and it catches even experienced, disciplined business owners. Accelerating expenses with no return on investment. Cash basis taxpayers primarily have the ability sometimes to manipulate, how they receive revenue, when they receive it, how they pay expenses, whether they prepay expenses. And all that's fine. I've got some fairly large ranching clients that do that every year. It feels great in year one. So here's the deal. You're in year one. You prepay $100,000 worth of fertilizer, feed, fuel, whatever it is. If that's allowed by the IRS, there are certain circumstances in which it's not. So don't take this as tax advice. Situations matter. But they spend $100,000 in year one. Great. It feels wonderful. They spent the money. They've reduced the tax to nothing. Now in year two, what happens? Normally, those operating expenses that would have been there are not there. They were paid for early. So now you've got a larger, higher profit year two. So what do you have to do? Do the same thing you did in year one and for at least that same amount. You see where I'm going with this? All you're doing is shifting from year one to year two. If you take a block of 10 years, assuming that you only spend what's ordinary and necessary and absolutely necessary on that business, you will pay the same bottom dollar in tax for that 10-year block. Now, whether you pay none in year one, a bunch in year two, a little in year three, a bunch in year four, none in year five, that's up to you. You get my drift. Moving those expenses around may shuffle you through the tax brackets, but the difference in brackets, they aren't that great. So you move from a 28 to a 25% bracket. 3%, is it really worth juggling all that stuff for 3%? And you farmers and ranchers, don't forget income averaging. You can income average. So that mitigates that need even further. So prepaying expenses, stockpiling supplies, locking things in early. It does several things. Number one, it probably skews returns from year to year. And it really doesn't do anything to create any sort of value at all. All you're doing is moving, and you think you're doing something. I could tell every client, go out and spend every dollar you have on anything you can that's deductible, and I look like a genius, right? But in reality, I'm not. That's poor advice. The most dangerous strategies are the ones that appear good on paper, but provide no real benefit, no financial benefit. You should ask yourself every time, how will this make me more money? How will this save expense? How will this reduce labor? How will this do anything of economic benefit to me? If it doesn't, and you're primarily doing it for the tax deduction, don't do it. I used to have a running joke. Clients would call and say, hey, I need to not pay any tax this year. What do? I say, how much profit do you have? 30,000. Pay it to me to do your tax return. I'll pay the tax on that money gladly. And they look at me like I'm crazy. And I tell them that's how much sense that makes to go out and spend money on something you don't need just to try to spin yourself out of a tax situation. Doesn't work. Now, spending money can be smart for those very reasons I mentioned. Increasing future cash flow, creating capacity or leverage. Maybe you get some sort of buying discount for certain volume, whatever that may be. Improve optionality. By that I mean reducing risk primarily. Maybe it's hiring to free up an owner to work on getting new business rather than doing whatever he does in the business or she does in the business. Maybe it's purchasing systems that reduce errors, automate things. Maybe that works. Equipment that increases throughput. That's the thing. Does it provide financial value? And then marketing, with a measurable return on investment. Don't just spend money on marketing just to do it. Those things make sense, and that's fine. If you're a growing business, it's fairly easy to reinvest that money back into the business and not owe any tax. And that's acceptable. You're growing. But what I'm talking about are these seasoned businesses that are at capacity or near it, and they're, at a plateau. And they're making great money. There are other ways to mitigate that tax, and sometimes there's no reason to mitigate the tax. One of the best clients I've ever had, he would almost be gleeful when I sent him a tax bill. One of the latest ones, the highest ones that I can remember, was $33 million he paid in tax and was happy about it. It was he and his brother in business together. And his brother, I could literally see turn red when I would sit down with them in my office and go through the returns. Turn red. He was smiling. Great job. Looks like I'm doing it. And now this guy's worth millions, almost $1 billion probably. I haven't looked at his net worth lately. But it's inspiration. It's for, your goal is to not get to the end of this journey and say, I've never had to pay any tax. Look how smart I am. You won't be in a better position than the guy that says, man, I minimized my tax. I mitigated that tax liability every chance I got, but only when it made sound financial sense. Only then. They'll be in a much better place. I've seen it. I'll talk about the 3 questions that I really ask. And we've brushed on this. Would I do this and spend this money if the tax code didn't exist? What does this purchase give me after I file the return? After I save the tax, what does it do for me? That's a great question. And am I okay with this decision if the IRS came in and disallowed it? Would I be still okay with the decision? If you can't answer those in the proper way, then it's probably not wise. The goal isn't to win this year's tax return. The goal is to build a business that still works after taxes, after audits, and after strategies wear out. Thank you for watching. If you like this, if it gave you any sort of value at all, please like, subscribe. I'd appreciate it. It gives me motivation.